Most people think tax increases happen when Congress passes a new law. But what if your taxes could go up even when tax rates stay exactly the same? The reality is that many parts of the tax code have not kept pace with inflation. So as incomes rise, investments grow, and retirement accounts increase in value, more people are finding themselves paying additional taxes, Medicare surcharges, and other costs they may not have anticipated. I'm Patrice Sikora, and joining me as always is your host, Jim Kruzan. Today we're discussing 5 stealth taxes. These can quietly impact retirees and investors. We'll also talk about why more people are being affected each year, and some planning opportunities that may help reduce surprises down the road. All right, Jim, let's start with the basics. What exactly is a stealth tax, and why should retirees be paying attention to them?
Yeah, great question. Stealth tax, as the name would imply, is either a tax that we really don't know it exists, or maybe it's a tax that we sort of heard about, but we thought, my goodness, the triggering event is so much further out, or it only affects those with much more income. It's not something we really need to worry about. And then along the way, the magic of compounding inflation and all the other things, we find out that we're right in the middle of its crosshairs.
So Congress doesn't have to do anything and taxes still can go up.
Well, that's the stealthiest part. Usually, when we talk about taxes, we may talk about the marginal rate and what that looks like, or the effective rate. We may even understand that the marginal rate may change a little bit based on income one year to another. And certainly, if Congress is putting forth a new tax bill, there's going to be a lot of talk and debate on that legislation. So we understand that, and we know it's potentially coming. With these stealth taxes, these things were put into place, written into law years, matter of fact, decades. In fact, as many as 4 decades ago. And because they were never indexed, because the limits that were put in place at the time still hold today, Congress just has to kind of sit back, and every year they're reaping in more and more revenue, simply because there's more and more people that are falling into this trap, falling into the crosshairs of all these various taxes. It's really quite interesting.
It's quite disappointing, actually. Congress should get on the ball here, but let's not go there. This is something else. Well, give me some examples of how this happens.
There's actually a number of them. And we'll start with one called NIT, N-I-I-T, NIT, Net Investment Income Tax. This thing's been around for well over a decade. In fact, it came into law back in 2013. In and around the time of the Affordable Health Care Act, the Obamacare Act. It was a way of collecting additional revenue that would offset some of the healthcare cost and be able to essentially spread some of the cost among all individuals within the U.S. And it affects, as the name implies, net investment income. So where most taxes affect your earned income, affect your total taxable income, this zeroes in on investable income. And there's a triggering event. That triggering event, which was established in 2013, was $200,000 of adjusted gross income for an individual, $250,000 for a couple. So you can imagine well over a decade ago, if you were filing jointly with your spouse, your combined joint income may have been well beneath $250,000.
Right.
And it's like, okay, not something I need to worry about. Well, now roll ahead, and especially this last decade or so, with much higher inflation, increases in incomes, increases in investment portfolios, we find this is becoming a triggering event. And when it triggers jointly held filers, we're looking at $250,000. It immediately looks at all of your investment income. That's income from capital gains, from dividends, from taxable interest, from certain annuity payments that you're receiving, and from passive income. So you own a share of an oil well, You're not actively working the oil well, but you receive income from it. Or you might own shares of a private company. You're not actively investing or rather running the business, but as a passive investor, you're receiving some compensation. All of that's considered sources for investable income. And the tax is 3.8%. So on top of your regular marginal income tax rate, should you trigger this, you go back and you pay this additional tax. Now, the tax is going to be paid on the lesser of two data points. One is the sum total of all this investable income that we just talked about, or the difference between what your actual adjusted income is and how far removed is that from the $250,000 limit. And you're taxed on the lesser of the two. So as an example, if you had $50,000 of net investable income and you had $350,000 of adjusted gross income, your adjusted gross income is $100,000 above the limit. It's better to pay the 3.8 on the 50,000 of taxable income than the 100,000 of difference between those data points. So because of that tax, it does take into consideration certain planning opportunities. So what are some of the things you could do that would affect this tax? One is you might consider actively tax loss harvesting. You know, if you've got an investment portfolio and you got certain losses, you might not want to sit on those losses. You might want to take them because that can offset income somewhere else. And that goes hand in hand with managing capital gains. If I've got a loss, I can take some gain off the table and net that against the loss and zero out the effective tax liability. The other thing you can do, and it's a lot easier to consider this if you've got a blank white sheet of paper and you're kind of planning ahead for a portfolio, is you may want to look at building your equity portfolio out of either individual stock issues and offerings or exchange traded funds, both of which don't throw off capital gains randomly as mutual funds do. You literally have to affect a change in the portfolio to affect a capital gain. That gives you control on the amount of gain you're going to take and the timing of those gains, which certainly helps with respect to this tax.
Jim, can a Roth conversion be used somewhere in here?
Well, actually, it's a triggering device. If you think about this is all based on adjusted gross income. So if you're doing a Roth conversion, you're adding to your adjusted gross income. And in the case where you might have been just underneath that $250,000 threshold or $200,000 as an individual filer, and now you're doing a Roth conversion because you think you're going to save federal income tax by dragging that ahead from what it would be in the future, you might actually do a bit of damage because now all of a sudden you're tripping some of this other stuff as well. If you don't have a lot of investable income, outside of an IRA, then doing a conversion might very well make sense. The key, and I'm sure we'll repeat this again at some point, is it makes sense to take taxes into consideration with all of your retirement-based planning and to do some kind of a pro forma where you're getting a sense for where things lie and where you are this year can drive a lot of those really neat wealth management strategies that everybody wants to talk about. But if you're not taking this stuff into consideration, you could do more harm than good.
There was another tax created about the same time that might trip up some working professionals. You were telling me about that one. Why don't you review that?
Yeah, it happened exactly the same time, 2013, for the exact same reason. It was to help fund or expand the availability of Medicare and the Obamacare Affordable Care Act. And this is a payroll tax increase. It doesn't seem like much. It affects the same people, same limits. 200,000 individual, 250 jointly. And it's a tax that would increase your Medicare tax payment that is generally withheld from you via your payroll. It's a payroll tax. that tax right now is 1.45%, and your employer also pays 1.45. This tax, if you're affected by it, is on you. Your employer does not participate, and it increases that tax rate by 90 basis points or 0.9%. So you're now paying, instead of 1.45, you're paying 2.35. Doesn't sound like a lot, but it's a 62% increase in what you were paying previously. And it's on those dollars earned over this threshold of 250. One thing about Medicare tax, unlike Social Security, it's not capped. You pay that on every dollar of earnings, no matter how much you earn. 200,000, 500,000, a million, 3 million, doesn't matter. You're paying that tax throughout. So an increase of 65% on that tax is quite a bit. For many of my clients who are still working, who are executives, highly compensated people, they totally pay more in Medicare on a yearly basis than they do Social Security. So imagine a 62% increase on that tax. The other problem that we see with this is it has the ability to create a lot of surprises come tax time. Because what normally happens is your employer is withholding Medicare, and the employer's payroll system is taking into consideration what you yourself make. So we have a number of clients who are engineers, husband and wives who are both engineers, and let's say they're making $175,000 a year each with bonus. Well, guess what? Neither one of them are going to trip either the 200 individual or the 250 joint ceiling number where they have to worry about this 0.9%. But come tax time, when they file jointly, they're at 350,000 income, 100,000 over the limit, and are now subject to this 0.9% tax, which, if we did the math, that's a fair amount of tax dollars, a few dollars, something to consider. And because it's not being withheld, there's a really good chance that they're going to owe it on the back end. And then, depending on how much it is relative to everything else, are we in a penalty or an interest situation where the IRS is now charging them or penalizing them because they didn't fully pay? So at the end of the day, there's a couple of things that we can do there too. One certainly has to do with compensation strategy, depending on how much the couple needs to run household. If one or the other has the ability to defer some of their income in the out years, potentially maybe when they're retired. Not talking about funding 401k, although increasing your funding on a pre-tax basis to 401k would certainly help as well. I'm talking about deferring some of the income which gets paid out in out years. That could help to reduce that a bit. And then the other thing is you can certainly embrace the fact that you're going to have this tax, call it a first world problem, but avoid the penalties and interest by maybe adjusting your estimated taxes, maybe increasing your payroll withholding to compensate for what you'll owe on the back end. That would at least save you some penalty and certainly some interest.
Social Security. Now, everybody gets a headache about Social Security, but this headache, many people don't realize, it can be taxed.
Oh, yeah. Yeah.
Oh, yeah, he says. Oh, yeah.
Well, this one in particular, you talk about one of these things that comes up and kind of bites you. This tax, or this way Social Security is presented from the standpoint of tax, has been around now since 1984. It was modified once back in like 93. But if you consider that, my goodness, that's well over 40 years ago. And prices have changed quite a bit. The value of a car, average salary, what inflation would have drugged prices across the nation, whatever it is you plan on buying. Yet this has not changed at all. And it was a way of Congress to position Social Security so that those who needed it most would get most of the benefit without paying income tax. And those potentially who needed it less, it was less important, had to pay a larger share of tax because more of the benefit would be included as taxable income. What makes this so strange is it's an entirely different language. You know, when we talk about taxes, we talk about your tax rate, your marginal rate. We might even get fancy and compute an effective tax rate. But it's all generally based on earned income, taxable income. We know what that number is. We have a general sense for what it looks like. We can sort of define what goes into that number. With Social Security, it's entirely different. They created this new way of positioning income. They call it provisional income. And provisional income is a really strange calculation. It starts with your adjusted gross income. That's usually where everybody's taxable income kind of starts, with some adjustments. And then you have to add back all of your tax-exempt interest. So if you were sitting there and you had a bond portfolio and had $5,000 or $10,000 of municipal bond interest, it wouldn't show up on your adjusted gross. It's not going to show up on your taxable income, but you have to add that back. And then you have to take half of what your gross Social Security payment would be, or the benefit would be, I should say, and you have to add that back as well. So it's adjusted gross plus tax-free income plus half your Social Security. Combined, that's called provisional income.
Who came up with this?
Well, yeah, right. It's like there's been a lot of thought into how to complicate this thing.
Yeah.
So then now that you've got your provisional income, well, what do you do with that? Well, you've got to look at the table, and the table just simply shows filing single, filing jointly. Let's look at the joint number. And if this provisional income amount is $32,000 or less, then 0% of your Social Security is includable as taxable income. Essentially, it's tax-free. If your provisional income is $32,000 to $44,000, and that's a very narrow bracket, that's only $12,000, well, then 50% of your Social Security benefit is now includable as taxable income.
That's a pretty steep jump from 0%.
Right. And if it's over $44,000, it now becomes 85% of your Social Security is included as taxable income. So this is something that needs to be considered when you're looking at things like Roth conversions or other types of ways of dragging forward some degree of income. It can be something that you didn't create. I inherited some money this year, and part of it was an annuity that cashed out or something else cashed out. And I have this other income that would be included in my adjusted gross that kind of skews these numbers a little bit higher. The problem with this is if done right, what you'd like to do is have a client, before they start Social Security, depending on how much money they need to live on, utilize some of their after-tax money. Think of that as money in the bank. And money in the bank doesn't throw off a lot of taxable income because interest rates aren't all that high. And if they're using that to foster their cash flow, they're in a very, very low tax bracket. If they're also at that point, maybe taking Social Security, they're also in a fairly low bracket, and more than likely their Social Security is untaxed because they probably don't have $32,000 worth of interest income. But then if they want to start getting fancy and say, hey, because our tax bracket is so low, why don't we consider doing these big Roth conversions now in a much lower bracket than where we will be down the road when all the spigots are turned on? And what that will do is that'll throw you into a much higher tax bracket, but you'll also trigger this thing called a tax torpedo as it relates to Social Security. So when you start looking at that, you realize, my goodness, that conversion, if I were to recalculate and look at what the effective tax of that conversion is, not only the higher marginal tax, but now all the tax I'm paying on all this includable Social Security, you might take a step back and say, this doesn't make any sense. It's better to wait until I'm in a higher bracket and then maybe do a conversion or just accept the income at that point than to try to get ahead of the game, because I'm being penalized so much because of all this other tax that I'm paying on this other income that I could have avoided paying taxes on currently.
Well, Jim, faced with that situation, what can somebody do?
Great question, Patrice. Several things. One, be very cognizant of Roth conversions. You may or may not want to do them. Take into consideration all the different taxes that this may release. Managing where your retirement income sources are coming from, really important. Do you want to take it out of a IRA where it becomes taxable income? Do you want to take it out of a non-taxable account? That certainly makes some degree of sense. If you have the ability to reduce your adjusted gross income by using QCDs or qualified charitable deductions, that certainly makes a whole lot of sense as well. So again, it gets back to, great cash flow management has everything to do with great tax management and kind of planning ahead and looking at scenarios and looking at the effective tax rate at each one of these scenarios is really the best way to go.
Now, you mentioned there's some things that you can do as part of your normal life, and you may find yourself with a surprise hit. We're not going to talk right now just about retirement income. What if I want to sell my house?
It's so funny because at our practice, we've had just an absolute number of clients bring up this topic of selling a home and what the tax hit would be and what does that look like and how are we going to go about paying that and everything else. And I think it's become much more of an issue, certainly in the last 6 or 7 years. After COVID, we had kind of that YOLO environment. You only live once. And you had a lot of people who were remote working, so they decided to move to really cool places, nicer environments, et cetera. And people would spend quite a bit of money on housing. And because those homes were located in particular geographic areas, a lot of those homes in those areas appreciated substantially. And now they're at the time when maybe they're winding down, retiring, whatever the case is. That law changed as well as it relates to taxation on homes. Again, almost 30 years ago, in 1997. Before that, the way it worked was if you had price appreciation on a home and you were buying a new home, and as long as you were buying it for approximately equal or greater value, you could just roll the appreciation in and continue doing that for a period of time. And then ultimately, when you downsized, there would be some realization. That all changed. At the time, Congress established this rule, which denotes a certain exclusion. This is the amount of money that you have to offset a capital gain on the sale of the home. And just to be clear, a capital gain on the home is the difference between what you sold it for and what you paid for it, net any improvement adjustments. So in the case of somebody who bought a home back in 1997 for $200,000, it's currently worth $900,000. You'd look at that and say, my goodness, that's a $700,000 gain. Well, if you file jointly, you have a $500,000 exclusion. If you file single, it's a $250,000 exclusion. So you take the $500,000 off the $700,000, and you still have a $200,000 capital gain. And we have more and more people these days who are getting tripped up by this because of the incredible amount of price appreciation we've seen on homes the last several decades for a variety of reasons. 0% interest rates, COVID, YOLO, whatever the case might be. And it's a big problem. So there aren't very many solutions. It is what it is. But really good record keeping and documentation is the key. Those who did not take advantage of moving elsewhere may have, because of YOLO, taken advantage of sprucing up their home and putting in large, complex redevelopments in the backyard, outside kitchens, redeveloping bathrooms and kitchens, or whatever the case is, putting in-home theaters. All of those things help to reduce the gain. All of those things help to increase your original cost basis, helping to wipe out that gain. So keeping great records of those types of permanent improvements really helps quite a bit.
All right. Now, this last example, technically this is not a tax, but it can feel like one when you see the bill.
It does. It does. Yeah, any way you want to look at it, it's a tax. The other ones we talked about were taxes. I guess the Medicare would be a surtax because it would be in addition to an existing tax. This is called a premium increase, but it really feels like a tax, and it's applied a lot like a tax. And this has to do with what you pay for Medicare.
Irma, our friend Irma.
Irma, right. And Irma in this case is spelled a little bit differently than most Irmas we know out there. It's IRMAA, which stands for Income Related Monthly Adjustment Amount. So to understand what that all means, if you kind of worked it backward, adjusted income amount. Well, what that means is that's the additional amount monthly that you're going to pay on Medicare, and what determines it is the income that you have related to certain benchmarks. So all this is a series of, if you think about it, ceilings. Each ceiling is a certain adjusted gross income amount. And as you blow through these ceilings, because your adjusted gross income is going higher, you wind up paying a whole lot more for the Medicare coverage you get. What it affects is your Part B benefit. Part A, as you know, is kind of free as long as you paid in the Social Security, et cetera. And it also affects your Part D benefit, which is prescription. And the first limit we'll use, I'll tell you what, I think we'll use couples. So filing jointly, the first limit is $218,000 of adjusted gross income. When you hit that, all of a sudden you start paying more for your Medicare Part B coverage, and you start paying an additional premium for your D coverage. And that continues to increase as the incomes go up. If you max out on income, essentially your Medicare premium is a little over 3 times what it started with. And by the way, when you look at these numbers, remember it's times 2 if you're filing jointly, because you have a spouse who presumably is also on Medicare, also is faced with the same premiums. So it's pretty significant. It's all in, if you max the thing out, it's like $19,000 a year, plus the cost of your D prescription, plus the cost of your Medigap coverage, on top of your B coverage, which is also built into the $19,000. So it's substantial. I mean, people can pay easily as a couple $25,000 or more per year for really solid Medicare coverage. So keep that in mind. And what's important there is to keep in mind where income is coming from on a yearly basis. Triggering events would be things like doing conversions without understanding how much conversion you can do without tripping one of these ceilings. Another would be, as an employee, not paying attention to your deferred comp, if you have that, and scheduling out when that deferred comp kicks in so that it all doesn't simply release that first year or so retirement spiking your income. Be mindful of receiving inheritances. If you can push off or layer in the income as opposed to receiving it all in one fell swoop, those are all things that you can do to help reduce your modified adjusted gross income. This is also stealthy because when you get hit with the additional premium, it's not because of something you're doing presently. It's not because of something you did last year. It's because of something you did 2 years ago. So be mindful, whatever you're doing this year isn't going to affect your Medicare cost at all. It'll catch up with you 2 years from now when you're on to doing something else. So it's important to be mindful of that. And the one area that we see this impacting clients the most is in this area that we would call widow's penalty. Right now, married couple, $218,000 is the triggering event of adjusted gross income. Should one of the spouses pass, there's a good chance that the surviving spouse will still receive the lion's share of that income coming in. If it's coming in and being generated from IRAs, they will usually get the higher of the two Social Securities. And if there was some kind of a pension involved, more than likely there is a spousal benefit to that. It might not be 100%, but it's something. More often than not, spouses will have a lifestyle that's not 100% of what was spent before, but about 80%. And they'll have a lot of the income adjusted to that. But all of a sudden, if they're filing single, that ceiling comes way down from $218,000 to $109,000.
Oh.
And we have a lot of widows, one in particular, we had this conversation this past year, where everything was fine. They never had to worry about this. And all of a sudden, she's wondering why she's paying several $100s a month more on her Medicare now than she ever paid before. And it was just this issue. So keep that in mind as well.
And as you say, it's not what you're doing today.
No.
It's 2 years ago.
Super stealthy.
Yeah. Well, Jim, is there anything we haven't mentioned? I mean, I'm sure there are lots of things, but to round out the conversation, we've covered so many taxes. My head is like spinning.
Right. I'm sure we could find a couple of other things to talk about that also can trip folks up. The real key is these 4 or 5. I guess housing is different, but the other 4 are things which we generally are faced with every day or every year. And it's important to get a sense for what taxes look like, where we are in terms of taxes before the end of the year, so that we have a better idea. Do we have the ability to just, not take any more out of the IRA this year if we don't need it to keep us under this one limit? Or maybe we don't take quite as much of a Roth conversion this year to keep us below this income limit as well. And by doing those things, you're just being a bit more mindful. You're being far more effective and far more efficient. We don't need to pay any more taxes than we need to.
Listeners, today we've talked about several ways taxes and other costs can increase quietly over time, even when Congress hasn't changed the tax rates. Many of these rules were put in place years ago, and they haven't kept pace with inflation, which means more and more people are finding themselves affected by them as their income grows, their investments appreciate, or they move into retirement. The good news is that understanding where these potential pressure points exist can create opportunities to plan ahead, rather than react after the fact. If today's conversation sparked questions about your own situation, reach out to your financial advisor. They can help you understand how these rules may apply to your retirement plan and whether there are planning opportunities worth exploring. And if you're not currently working with an advisor and would like to start that conversation, we'd be happy to connect with you. You can learn more at kaydanwealth.com. Follow @KaydanWealth on social media and let us know what you think in the comments. Your feedback and topic suggestions help us improve and make a bigger impact.
Thank you for listening to The Retirement Engineer with Jim Kruzan. Click the follow button to be notified when new episodes become available. Visit our website at www.kaydanwealth.com or give us a call at 800-638-6900. The information covered and posted represents the views and opinions of Jim Kruzan and this episode's guests, not necessarily those of Kaydan Wealth Management. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning.